99.9% of cryptos have absolutely zero fundamentals. In this video, we're going to be looking for the 0.1% that do. We're looking for projects that have real revenue and that distribute that revenue back to token holders in some form. Now let's get into it. If you're like me and you've been investing in crypto, then you are sick of all of the scams and overhyped projects that completely dominate all airwaves with the space. So on this channel, I'm trying to give more publicity to the businesses, the protocols, the projects that are actually sustainable, that are actually generating real revenue. And if you've been watching my videos for a long time, you know that I've talked about this a lot over the past few months, how it's easy to get disillusioned, but if you believe that more of the economy is going to move on-chain, as I do, and you believe that more assets are moving on-chain, they're being tokenized, as not only I do, but a lot of the biggest financial institutions in the world, BlackRock, etc., do, then you know that there's still huge opportunity in identifying businesses that are being built on-chain and finding investment opportunities there. And so in this video, we're going to try to parse out some projects that are actually earning money today, and importantly, that are actually distributing that money to token holders, and even more importantly, that are doing it without the need for insane token incentives that are sometimes even more than the actual revenue they're bringing in. Also, quick note, nothing in this video is investment advice, it's not financial advice, and any of the assets I talk about, you still need to do your own research to make sure they fit into your portfolio and they fit your risk profile. There's more that goes into buying an asset than just seeing that it has the fundamentals. That being said, we're going to try to find some assets with solid fundamentals in this video. And to do that, the main resource I'm going to be using is our trusted friend DeFi Llama, which tracks revenue for over 1,000 projects. Full disclosure, I'm the head of growth for DeFi Llama as well. But I'm happy to do that because it's a phenomenal resource that I was already using. And so DeFi Llama, if you see their fees and revenue, they track 3 different types, well, really 4 different types: fees, revenue, holders revenue, and earnings. So fees, that's everything the user pays, and some of that goes to the project, some of it goes to token holders, some of it goes to people who are providing liquidity to the exchange if it's an automated market maker, so on and so forth. A lot of these go to other users that are participating in the other side of the marketplace. Revenue is the portion of fees that actually accrues to the project, the token holders, the project treasury, etc. Then holders revenue is the sub portion of revenue that actually gets distributed back to token holders. So that's what we're focusing on today. We want to find projects that are earning revenue and passing on that revenue to token holders. And a quick note, I usually, or for this video, I'm not going to focus on chains. I'm going to focus on protocols. So I'm removing chain here. And then the 4th category is earnings. This is a new one. And what earnings shows is the revenue minus any token incentives they're paying out. So there's some protocols you'll see that are earning a lot of revenue, but they're actually paying out even more in token incentives for people that are using the protocol. And by the way, token incentives, totally fine. I mean, crypto is built on token incentives. DeFi is built on token incentives. It's the whole reason why many people were attracted to yields in DeFi in the first place. And token incentives are a phenomenal way to bootstrap a network, phenomenal way to bootstrap a decentralized application. They solve the chicken and egg problem. They create value alignment. That being said, if you're talking purely from an investment standpoint, there is a downside to having large token distributions. The downside being that many of those tokens are going to get sold. And so if you are earning a certain amount of money that goes towards token holders, but then you also have sell pressure from, or say you're earning money that goes towards buybacks of the token, but then there's sell pressure from tokens coming onto the market, and the sell pressure is significantly more than the buy pressure from the buybacks, the token price is likely to go down. So we're looking for things that have just such overwhelming positive fundamentals that one could conceivably construct an investment thesis. All right, enough theoretical rambling. Let's talk about the protocols that actually fit these criteria. So I'm going to sort by 30-day holders revenue here. And let's see, we've got Hyperliquid, we've got PancakeSwap, Aerodrome, Radium, Shadow Exchange, and you can see in this column here, you can see where all these, like the description of what's going on with their fees. So for example, We can see that 93% of fees on Hyperliquid go towards burning tokens. The remaining go to the HLP vault. And you can see others here. A lot of these are going to be buybacks and burns. Occasionally you have some like GMX that are going to be fee distributions. And what I did actually before recording this was I went ahead and I pulled out many of the top protocols here and then recorded their revenue, their holders revenue, their market cap, and their fully diluted valuation in the spreadsheet. And what we want is we want things that have a high holders revenue to market cap ratio, or even better, a high holders revenue to FDV ratio. Reason being is that FDV is the fully diluted valuation, and oftentimes investors take that into account. So it does matter for the value, for the market cap, especially as the space becomes more mature. And additionally, if you're looking at a long-term hold, as probably makes sense with these kinds of digital assets, then you want to make sure you're accounting for potential future dilution. And so the first protocols that I identified were Hyperliquid, Aerodrome, Radium, Boop.fun, GMX, Velodrome, Jupiter, Shadow Exchange, Convex, Pharaoh, CL, and Sideshift. Now, some of these are subsets of other protocols like Pharaoh, but the numbers account for all of that. And so what did I find here? Well, first thing I found was that certain protocols, you'll notice, have extremely high holders revenue to market cap ratios. To name a few: Shadow Exchange, this is a decentralized exchange on the Sonic network. Pharaoh, that's a decentralized exchange on Avalanche network. Boop.fun, that's a launch pad. And then you have some that are, these ones are just crazy, where annualized revenue is actually more than the market cap. But you have some that also have extraordinarily high annualized revenue. You have Aerodrome with 0.37 ratio of holders revenue to market cap. Then you also have some that have high ratios, but not quite at this outlandish over 1 ratio. For example, you have Aerodrome with a 0.37 holders revenue to market cap ratio, and you have Velodrome with a 0.24 holders revenue to market cap ratio. Now, the issue with some of these, or the commonality I'll say with some of these, is that a huge number of these with the high ratios, Velodrome, Aerodrome, Shadow Exchange, Pharaoh, these are all decentralized exchanges that use the V33 tokenomics model. And this tokenomics model is in a way optimized for holders revenue, because the way that it works is it passes on all revenue to token holders and then uses tokens instead of revenue to incentivize liquidity. So it kind of uses tokenomics to move some things around that would normally be organized a different way. And the result is that holders revenue is very high. And so I do think it's fairly important to take into account token distribution with those. And I actually like some of these projects, right? I mean, I've covered most of these projects in the past, and I would continue to cover them very positively. However, that's why one might look at earnings as well. And earnings, again, subtracts out the token incentives. All right, so if we actually subtract out the token incentives, what do we find for these projects? Well, we find is that some of them, suddenly the earnings are negative. We have Aerodrome has more token distributions than revenue. Velodrome, same thing. Shadow Exchange, also the same thing. Shadow Exchange, in fact, the earnings, the token distributions are actually very substantial compared to their circulating market cap. We do, however, see that there are certain projects that still have positive earnings. We do, however, see some that still have positive earnings, notably GMX and Pharaoh CL. Again, this stat is relatively new on DeFi Llama, so it's not available for every protocol yet, but we will take into account the tokenomics of the protocols that it's not available for. And so we're going to look deeper at GMX and Pharaoh. Another one that I want to look at deeper is Sideshift, which has a very favorable holders revenue to FDV ratio. We're going to look at Boop.fun to see what's going on there. And then another one that I want to look at is Convex and Radium. And Hyperliquid, truthfully, one could look at as well, but I have another video coming out, several videos that are about Hyperliquid as an investable asset and the thesis behind that. So check out that video specifically on Hyperliquid, but we're going to focus on these other ones in this video. So let's look at some of these. All right, so we go back to holders revenue here. We want to look at Radium. We want to look at boop.fun, Convex, Pharaoh, and Sideshift. All right, I think we hit all of them there. Yeah. So, oh, GMX. So we want to look at GMX too. All right. So let's look at all of these. And the thing I'm looking for here, okay? So to recap, we've now found protocols that have high holders revenue. That's revenue being distributed to token holders. High holders revenue compared to their fully diluted valuation. And at the very minimum, we have not found evidence that they have negative earnings, right? We still need to look at the tokenomics for some of these. Now what we're looking for is the sustainability of that revenue, because we're looking at annualized revenue. But there could be a protocol that is hypothetically a few months old or that had a sudden spike in revenue. And we can't really trust that if you hold this for 6 months, the revenue is really going to amount to anything, because it may just be the season, if you will, for that protocol. So let's look at some of these now. And to start, we'll look at Radium. Now Radium, if you look at this, you see this huge spike in July. Let's fast forward to get away from that. And we see something weird is going on here because revenue and holders revenue are different. So it's quite clear to me that this is something that was either just turned on or is somehow variable. So let's look more at revenue to understand how sustainable this is. I'll look at weekly to make it a bit easier. And what we see here is that this has heavy spikes and also declines, has ebbs and flows. And the reason for this is that Radium is the leading decentralized exchange on Solana. And as a result of the fact that pump.fun tokens historically have moved from pump to Radium when they reach a certain market cap, it receives significant volume from meme coins. You can see, for example, this volume here coinciding with the launch of the Trump token and probably the peak of Solana meme coin activity. You can see this huge jump in revenue. And then as things started to get some traction again in May, you saw another spike in revenue followed by a multi-week decline. And so the verdict on this is, I mean, it's not necessarily just a flash in the pan, if you will. This revenue has been substantial, oftentimes hundreds of thousands or millions of dollars a week, going back over a year now. However, as we can see, it is very tied to meme coin season. And for that respect, I would say that Radium has been around for a while. It's shown some durability in terms of revenue, but there is a risk that the annualized revenue or the actual annual revenue ends up being significantly below the annualized revenue. Another thing to consider here is that Pump.fun has since launched their own DEX. So if memes continue to be a dominating source of economic activity on the Solana ecosystem, then Radium will be less of a beneficiary of that than they have been historically. Next one that we were looking at was Boop.fun. Now remember, this one had a very high holders revenue to FDV ratio. So let's look at this. Well, the first problem you see is their revenue only goes back to about May, their holders revenue. Let's see if revenue goes back further. Not really. All right, so this is only a month old. And as you can see, it was very substantial earlier in the month and then has really fallen off. We're only looking at the daily chart here because there's only a month of data. Has really fallen off to, I mean, $5,000 to $10,000 a day. Now, I would be happy if I launched an app with $10,000 a day in revenue, right? But this is not me launching an app. This is a project with FDV of $58 million. And so in that case, I'm going to say that's just not enough data to confidently believe that this is going to last into the future. Next up, we have Convex. Convex is an Ethereum project in the Curve ecosystem, and it's a very important project in DeFi, especially as far as maximizing yields related to Curve. Now, Convex, there's a couple things going on here. First off, you'll notice holders revenue has been in a steady decline since its peak in early 2022. Since last cycle, it does occasionally have bumps, but it's basically been in a steady decline if you look at it monthly here. However, if we overlay market cap on top of this, let's zoom in. Let's just remove that and look at that. We can see market cap has also been in a steady decline since market cap peaked a month before, but market cap has also been in a steady decline. So as a result, maybe we can say that the the ratio has actually not declined as much as you would think. So for example, in May, the ratio was about 260x market cap to holders revenue. We go back a couple of years. Let's go back to May of 2023, and we can see that the market cap has also declined significantly. So perhaps it's not as big of a concern as one might think. The revenue is still very substantial. That being said, in order to invest in this, I would need to have a thesis on why Convex revenue would increase in the future. And you can think of some theses on this. Curve is, after all, the premier decentralized exchange for stablecoins. Stablecoins are the asset that's gained the most, the digital asset that's gained the most real world adoption, probably one of the most important macroeconomic and tech developments that's happening at the moment. And so I think it's possible, once the stablecoin supply grows from 250 billion up to $1 trillion, there could be a lot more activity on Curve, and as a result, more revenue for Convex. That being said, this kind of decline, if we're looking purely at fundamentals, is not really ideal, right? You'd rather it at least be holding steady in that time. And perhaps for the past year, it has been steady. Would like to see this maybe take up a bit or show some organic growth. Next up, we have Pharaoh. Now, Pharaoh is one of the smaller ones we've looked at. Its market cap is quite small and thus risky. And I'm saying this to warn you guys, it's fairly risky. However, it has a very high volume compared to its market cap, volume being the volume that's actually traded on it, and a very high volume compared to its total value locked, about almost 100% in 24 hours. And if we look at the actual holders revenue here, then we can see it has jumped up this year in a major way. Even after retracing from February, it's still up substantially. And going back, further, we can see that it does show a fairly strong growth trend going back at least to October, and even before then, it was holding steady at roughly $50,000 plus many weeks and $10,000 plus the other weeks. Next up, we have Pharaoh Exchange. Now, Pharaoh Exchange is a decentralized exchange on the Avalanche network, and it has the smallest market cap of all the projects we've talked about so far, of under $5 million. So the caveat here is that this is very risky. That being said, it is processing a lot of volume at over $40 million in the past 24 hours. And that's a huge amount of volume, not just compared to its market cap, but also compared to the amount of liquidity on the exchange. If we look at the mid to long-term trends, we can see that since last year, it's experienced substantial growth. A typical monthly revenue growing from $150,000 for much of last year to $1.26 million in May. And although it has declined from its peak in February, you can still see that it is up substantially from where it was prior to December, really prior to January, but especially prior to the US election. And I call that out because a lot of tokens have retraced or nearly retraced to their prices then. However, the fundamentals for this have improved. I actually don't know whether the token price has retraced or not. And you can see that the token price is up, but it has actually mostly retraced. And so this one, I actually have to say this growth looks fairly good. I mean, in crypto, you have to condense your time frames a little bit, where you're probably not going to find something that has consistent revenue going back like 4 years, simply because most protocols are new. However, this looks like, they're getting some organic traction. They've managed to not crash too hard, even with the market cooling down. And they are still up substantially from last year with a low market cap. So this one actually looks pretty decent. Next up, we have Sideshift. Now, Sideshift is also quite small, but is bigger than Pharaoh, with a market cap of 20 million, FDV of just under 29 million. And let's go ahead and we'll get rid of fees, and we'll condense this by month. And now this one is very interesting to me, because this one goes back about a year, and you can see it's been pretty steady throughout that year. So this This looks much more like a classic, like, okay, this project is just generating steady revenue. I guess it coincides with market cycles because it peaked in December and then declined, but now it's almost back to that level. Basically, this thing has been generating consistent revenue that it's distributing back to token holders for a solid year now. And what's interesting is that if you actually look at the tokenomics, you see that this is literally redistributed, revenues redistributed directly. So daily users receive a 25% share of Sideshift revenues. And so this one also, I would say, looks solid. The FDV isn't that much higher than the market cap. So even if they are using incentives, again, we don't have earnings available for this protocol, then they would have to be basically unloading all of this in the next year to give it any sort of ratio that any sort of incentives to revenue ratio that wasn't favorable. Last but not least, we have GMX, and for a long time, GMX was one of the leading perp dexes, and in terms of money making, it actually still is. If we look at the holders' revenue here, then we can see that it is generating a substantial amount of monthly revenue. Millions of dollars virtually every single month, including over $5 million in April and $1.55 million in May. And now one thing that's interesting to note about GMX is that it was really a trailblazer in terms of tokenomics, where go back to 2021, 2022, even further back to 2020, there was always talk about valueless governance tokens that don't actually give you any real claim to any profits or revenue from the protocol. GMX flipped the script on that and actually codified distributing a portion of their revenues directly to token holders. And as a result, they've had very strong revenue for a number of years now, even more so than Sideshift. This perhaps amplifies the example of a sort of protocol that you could say, okay, yes, this is a business that is generating real revenue, that's passing on that revenue to stakeholders, and that it's been doing it for a number of years now, so you can have some more confidence that they will be able to in the future. Now, I would say one risk with GMX is that in recent years, even as perp dexes have taken off, their perps volume, it's perhaps stayed steady with what it was, but they haven't really been able to grow as much as you might expect with the expanding market for perp dexes. And I think a big part of the reason why is that the expanding market for perp dexes is largely driven by Hyperliquid. And by the way, I love the GMX project, great team. Just talking about the numbers here, and definitely as more people switch to trading on chain, would like to see them not just maintain but actually grow their volume and revenue. If you find these kinds of analyses helpful, check out my newsletter, because not only do I publish on-chain analysis every week, but pretty soon I'm launching something new that's going to help you invest in crypto based on fundamentals. And I'll announce it first in my newsletter at newsletter.dynamodefi.com. If you want to see more videos like this, be sure to like and subscribe. Until next time, this is Dynamo DeFi.